Okay, let's get real here. Imagine working your entire life, paying into Social Security, and then, you get $2,000 a month. That's it. $24,000 a year. Now, I'm not here to bash Social Security, plenty of people rely on it, but what if I told you that with the right investing strategy, you could outrun that check without touching your principal? Sounds like a pipe dream? Let's break down the numbers, but more importantly, let's unpack the trade-offs most people completely overlook. \n. First off, the math is simple. Income target divided by yield equals the capital you need. But here's the twist, most folks focus on the yield without asking what that yield costs them long-term. Take the conservative tier, blue-chip stocks like Coca-Cola or Johnson & Johnson, yielding 2 to 3%. On paper, you'd need nearly $700,000 to hit that $24,000 goal. That's a lot, right? But here's what fascinates me, these companies don't just pay dividends, they raise them. Johnson & Johnson? They've increased payouts for over 60 years. So while the yield looks low today, that $24,000 check could double in a decade. The aggressive tier might give you 10% yield upfront, but if the fund's value plummets or the dividends are just your own principal being handed back, you're not building wealth, you're burning through savings. \n. Let's talk about the elephant in the room, risk. At 6% yield, the moderate tier, you're looking at REITs, covered call ETFs, maybe preferred shares. Lower capital needed, $400,000, but the growth slows. Covered call funds cap your upside because they're selling options. REITs? Their dividends often come from cash flow, not compounding. And if the market tanks, these assets get hammered. Meanwhile, the aggressive tier, business development companies, mortgage REITs, those 12% yields? A ton of them include return of capital, which sounds fancy but really means you're eating into your nest egg. 10 years later, your portfolio might be worth less even with those fat checks. \n. Here's where people get it wrong. They chase yield like it's the only metric that matters. But the growth rate of your income is what actually protects you against inflation and longevity risk. A 3.5% yield growing 8% annually will double your income in 9 years. A flat 10% yield? Stays flat. And if the fund's net asset value drops, you're getting the same check, but that check's buying power is shrinking. Think about it, even a 10-year treasury at 4.6% would require $500,000 to match Social Security, so why take on stock market risk if you're not getting compensated for it? \n. Now, let's zoom out. This isn't just about numbers, it's about mindset. The conservative tier is a long game. You're betting on companies with decades of dividend growth, weathering recessions, adapting to trends. The aggressive tier? It's a sprint, and too many retirees treat it like a free lunch. And here's the kicker, taxes. Qualified dividends, REIT distributions, bond interest, they're all taxed differently. Oh, and guess what? That extra income could push your Social Security into taxable territory. Suddenly, the tax-free part of your check isn't so free \n. And so what's the takeaway? It's not about replicating Social Security, it's about outthinking it. Ask yourself, do you want a paycheck that grows with inflation, or one that looks good today but fizzles tomorrow? The answer determines whether you're building a legacy or just burning through assets. And hey, if you're thinking about diving into dividend investing, don't just ask, how much do I need? Ask, what am I sacrificing, and is it worth it? Drop your thoughts below. How would you balance yield versus growth in retirement?